And welcome to the study circle meeting on practical insights in TDS provisions, tax deducted as source provisions. So we have our speaker Deepak Chopra, CA Deepak Chopra for this session. I request our chairman Pramod Aregde to escort the speaker to the dais and greet him. Welcome to you, Deepak. I request our chairman to give the
Good evening, members. Welcome to each one of you for this today's study circle meeting on TDS. Bangalore branch has of late conducted already 2 to 3 TDS sessions. If you see TDS, TCS, which was extensively dealt. When you come to this income tax per se, which is a everyday learning subject because of lot of amendments and changes in the Act, the practical implication also keeps on changing. So, I requested CA Deepak Chopra, why not take the practical aspects of this TDS, which is not being dealt till date, and probably if you have missed out in something, and there's quite a lot of learning even in TDS provisions itself. So that's the reason I requested CA Deepak Chopra to delve into it onto a fully practical mode. So that is the agenda for the day. Also, I would like to request members to use this early bird registration which is going on for the startup sphere. This one of its kind of event, first time, which is hosted by Bangalore branch, which used to happen in Geo World Convention Center in Mumbai earlier. This is scheduled in KTPO on 27, 28 and 29th of the June month. And this is basically an ecosystem which we are trying to create between the startups and to create a lot of opportunity for our own members with the startup ecosystem to increase our potential to understand, analyze. If you are not people who are already in startup system, it becomes a very networking activity so that they can explore their further options. People who have not even encountered startup or who doesn't have the practice of startup, why not to think about those lines? Why don't you get into the new aspects of startup ecosystem? And there are the opportunity in the startup ecosystem is put very phenomenal. So with this, I would like to welcome you all, and I would like to hand over the dais to Deepak Chopra. Before that, I would request our secretary to briefly introduce him. And I know Deepak is always a patient guy who can always answer any silly questions we ask. So with this, I would like to hand over to us. Thank you.
Thank you, Chairman. CA Deepak Chopra is a very well-known name when it comes to income tax sessions in the branch or outside in South India. He has a unique way of delivering things and a unique way of conveying matters, so it becomes easy for us to understand. He is a fellow member of the Institute of Chartered Accountants and has graduated in Commerce from Bangalore University, qualified in the year 2011. He has a strong passion for direct taxes and has been regularly taking classes across many places of ICA branches across South India. He has also been the faculty for officers of Income Tax Department at the Direct Tax Regional Training Institute, Bangalore, and he is also presently serving as the chairman of Direct Tax Committee of KCA, and he is a founding partner of Deepak Neeraj and Associates, where he heads the Direct Tax Division. It's a pleasure to introduce him to you all, and Deepak, welcome to you and thank you for being here. Over to you.
Namaskar and a very good evening to one and all. At the outset, thank you Bangalore branch for providing this opportunity. Thank you attendees for coming here, with whom I'm sure we're going to have an interactive and a knowledge enriching deliberation today. So the topic that we've reached on today is tax deducted at source, practical insights. First things first, why on earth this session for today, a 2-hour session? TDS provisions are simple, routinely applied in daily practice, short and sweet. This chart, which you will find pinned on the office boards of all our desks, beautifully summarizes TDS provisions, right? It's a 2-minute study. Why spend 2 hours on TDS discussion? That's a question that one may have in his mind. Also, in the past 2 to 3 months, we've had at least 2 deliberations, 2 hours full-fledged deliberations on TDS provisions. So is there anything more left to deliberate on with regards to TDS provision? Is there going to be any value addition that the next 2 hours is going to create in our professional life? It's something that we'll have to together answer towards the end of the session. So we'll keep this question open, we'll leave this question open to be answered collectively by us towards the end of today's session. So before we begin with our session, we have to set some boundaries for ourselves. We have to fix on a syllabus within which we are going to spend our next 2 hours. And that we will by fixing on a negative list of items which we will not deliberate today. Starting with the lesser used TDS provisions. 194B series, 194DA, EE, L, G, K are provisions which are not applied in daily practice and something we will park it outside our deliberations for today. Right? The mandate today is to focus on daily use provisions which are of relevance for daily practice. So bearing that in mind, these are items which will stay out of our today's discussion. We also have to be mindful of the time constraint that we have. 2 hours, 1 hour, 45 minutes is all that we've got. So within the available time, what we cannot discuss are provisions which individually seek a dedicated 2 hour session. Right? Provisions like TDS on non-residents, 194R, 194S, 194BA, 194 IC are provisions which in themselves seek a dedicated 2 hour session, and which is what we will keep it out of today's discussion. Lastly, basics of TDS provisions, rates, applicability, threshold, due dates, return filing procedure is something that is well known, and we have also deliberated the nitty-gritties of it in the previous 2 sessions hosted by Bangalore branch. In case you missed out, it is available on the YouTube channel of Bangalore branch. You can always log on to the YouTube channel and have a refresher course on TDS provisions with those videos. So now that we have set our syllabus, let's begin our deliberation on TDS provision with some trivias, small pieces of information, more to test our knowledge or entertain us than to add real practical insights to our life. Beginning with, any guess on number of TDS provisions that we have to deal with today? A broad guess. TCS apart, TDS provisions only. How many TDS provisions do we have to deal with in a daily practice today? A rough guess.
Maybe 5 to 6.
5 to 6. Way off the mark, sir. Way off the mark.
No, but in broad sense.
All in all, how many TDS provisions are applicable? A given transaction has to be tested against how many TDS provisions before coming to a conclusion whether or not TDS is applicable. Any more guesses? No negative marking here. Anybody? Why this? 15. 15? Still off the mark, sir. So we have 5 raised to 15. Any more attempts? 38 TDS provisions are applicable. There are 38 TDS provisions in the statute. Any guess on how many TDS provisions have been inserted in the last 1 decade? of 38 provisions that we currently have in the statute, 18 provisions have come into the Act since 2012. So nearly 50% of the TDS provisions that we see today are inserted into the statute books in the last decade or so. This is the list, starting from 2012. So what does this story of growing TDS provisions tell you? What indicators do we get from the government when we see a new TDS provision being inserted in the statute books every year, year after year, year after year? Government is happy with TDS provision, yes, of course.
You want to track the
transactions. Capturing every transaction that is missed out.
Capturing every transaction that is missed out, okay.
more number of fees under the tax bracket.
Okay. So clearly, TDS provisions are doing a phenomenal job in achieving their objectives, right? Which is why government is so fond of them, and we see a new TDS provision inserted every statute, every finance act. Now, what objective do these TDS provisions serve? Primarily, to my mind, two objectives. Number one, of course, accelerated tax collection. But for this TDS provision, thanks to which money flows into the government coffers every month before 7th. But for this TDS provision, taxes would have flown into the government's coffers quarterly by way of advance tax, or worse, annually by way of self-assessment tax. The TDS provision do a phenomenal job in accelerated tax collection. That's number one. Objective number two, which of late is getting far more prominence, is information collection. A lot of these recently introduced provisions that you will see are not for the sake of tax collection as a primary objective. The primary objective of lot of these sections is data collection, information collection. Look at 0.1%, 194Q on purchase, 0.1%, 206C, 1H, 1 sale, 194N, TDS on cash withdrawal, TCS on sale of car more than 10 lakh. This is not for that 1% or 0.1% that government has introduced these provisions. Provisions are primarily introduced for data collection, right? Once a transaction suffers TDS and it is reported on Form 26A, it is very hard for it to escape the tax net. I'm sure all of you would agree with me. Once a transaction is brought into the TDS net, it is more or less guaranteed that it will also get captured in the annual tax net as well, right? Okay. So this is one small little trivia on TDS. We have a couple more before we get into the core of our discussion today. When should tax be deducted at source? Normal understanding. At what point should it be deducted at source?
Before the payment is made.
At the time of payment or credit, whichever is earlier, is the most popular understanding of TDS provision. This is what it applies to majority of the daily use provisions that we normally deal with. But then there are a bunch of sections which will ask you to deduct tax only at the time of payment. Salary 192, very good. Yeah, that's one. That's an important section that we deal with on a daily basis. But then the requirement to deduct tax at source is on payment basis and not earlier. Right? Anyone? 195, no sir.
TCS
TDS. Today's discussion is only on TDS. Okay. 194Q is payment of credit, which was earlier, sir. 192, 182A, EPF payments. 194B series, winnings, online games, horse races. 194QB is again payment or 194QB, I believe you mean 26QB, 194IA is again payment of credit, whichever is earlier. So here is a list, a complete list of provisions which require tax deduction at the time of payment and not earlier. Right? The ones in red are possibly ones which will interest in our daily practice. As I said, 192, 192A, 194 dividend. Again, there the requirement to deduct tax at source is on payment, not at the time of credit. 184B, BA, BB, the online and TDS on lotteries and winnings and games. 194N, 194R also requires you to deduct tax at source on payment basis and not before. But you know the best part in this trivia? There is one section in the Act, one TDS provision in the Act, which does not tell you when to deduct tax. Any guess? A recently introduced one. 194R, before releasing the payment, you have to deduct tax at source. So that's at the time of payment in that sense. There is one provision which fails to tell you the time at which tax has to be deducted at source. Not something that we apply in our daily practice, but then again, this is trivia. 184P. 184P, introduced by Finance Act 2021, which talks of TDS on payouts to specified senior citizens more than 75 years of age. If you have only interest income and pension income, then you file a Form 12 BBA with the banker. He will do your tax computation, he will do your tax deduction, and you don't have to file a return of income. There, rightly or wrongly, the provision, it's there on the screen for you to verify. The provision fails to tell us the point of tax deduction. Should I do it at the time of payment? Should I do it at the time of credit? It fails to tell me the point of deduction. So, when should I deduct tax at source? Something for the banker to worry about. But then there is some indication given to us in the rule. So, Rule 27D, which deals with this, tells you that upon receipt of declaration from the senior citizen under Form 12 BBA, at that point of time you will do a deduction, and once you do the deduction, of course payment has to be made before 7th of subsequent months. For months starting from April to Feb. For the month of March, payment has to be made before 30th of April. Those are indeed something that we are well aware of. Okay. We have specific set of TDS provisions applying for residents and a separate set of provisions applying for non-resident. Right? Professional fee, if it is being paid to a resident, I will go check under 194J. But if the same professional fee is being paid to a non-resident, then the section that I will have to test on is 195. So, in a sense, a TDS provision applies either to a resident or to a non-resident. Right? These are the list of TDS provisions applicable to a non-resident. Then these are the list of TDS provisions applicable to a resident. But then there are a bunch of provisions which are applicable to both. Any guesses? 192. Salary. If you are paying salary, whether you are paying to a resident or to a non-resident, the section applicable to you would be 192. Okay, any more? 192A, that EPF payment, and those winning from horse races, online games and all that. That series also requires tax deduction under 194B, BB, BBA and so on. Right? Okay. We'll quickly move on to the last trivia over here. If you are an SSC who does not want to suffer TDS, you are a recipient of income, you are the payee, you are not the payer, you are the payee, and you want to be out of the TDS net. What options have you got? Theoretically, you got two options. File a 15G, 15H under 197A, or go to the assessing officer, Form 13, take a loan reduction certificate or a loan reduction certificate under 197. These are the only two theoretical options available to you, right? 197A, Form 15G, 15H, can I submit for any payment? That's a very small set of sections wherein I can utilize this option of, avail this option of Form 15G, 15H. I am due to receive 50,000 in professional fee or commission income. 194J or 194H does not permit me to take this 15G route or 15H route and avoid TDS. Right? It's a very small set of sections. Again, it's there on the screen, and this presentation is anyways going to be shared with you. A very small set of sections where I can avail this 15G, 15H route. But then Form 13 route is a much wider route, right? There's a lot more number of provisions wherein I can use this Form 13 route to either bring down my TDS rate or totally have it nullified by the assessing officer. But then there again, there are a bunch of TDS provisions when the Form 13 route is also not available to you? Any guesses?
Winning.
Winning from horse races 194B BBA series, it is not available. Yes, nice. 192A, 194Q, already 0.1%. How much more lower rate can you ask for with the assessing officer? Right. So again, so the sections in red are the ones where you cannot seek a lower deduction or no deduction certificate from the assessing officer. Okay. We are done with that set of trivia section. We will now get into some case studies, right, to understand various practical implications. Although I am saying practical implications, here and there I will slip into some academic questions also. May not have real practical application, but then they are again nice to know, and you never know when you will have an opportunity to apply them. Probably the first one is something that falls into that second category. So the way these case studies are going to function is, it's going to be in a Q&A format, right? Question and answer format. Question, answer, right? So I'll read out the question and together we'll try to find out the appropriate answer to the question. Mr. A is a salaried employee working for a MNC, drawing annual salary of ₹5 crores. He employs a domestic help to whom he pays annual salary of ₹12 lakh. Is Mr. A required to deduct tax at source on the salary paid by him? It's a theoretical question, sir, hypothetical question. Who will pay domestic help 12 lakh rupees? This is actually this is a question that sprung to my mind when I recently read a news article which said Ambani's pay, rather Nita Ambani specifically pays her domestic help 24 lakhs annum. That is when this question sprung to my mind. Is she required to deduct tax at source on the payment that she makes to her domestic maid? Yes. Yes. I also hear a no. Yes, no will have to be further elaborated. The answer is either yes or no.
It's a personal expense.
It's a personal expenditure, so no TDS. Okay, that's one answer that I have.
So why you have to deduct TDS? Because he is a salaried employee.
He is a salaried employee, no business, no accountant,
No tax audit applicable.
no tax audit applicable. He is not claiming business expenditure also. Okay.
Section 192, even though tax audit is not applicable, you have to deduct.
Section 192 gives you no relaxation, even though tax audit is not applicable, you have to deduct tax at source. Let's see. Let's read 192 because that's where our answer lies. Any person responsible for paying any income chargeable under the head salaries shall, at the time of payment, deduct income tax on the amount payable at the rates in force. That's how the section goes on. So if you read the opening provision, it says any person responsible for paying salaries. Absolutely no exceptions, no exclusions. Any person means every person who is making salary payment is required to deduct tax at source under 192 subsection 1. But then you will have a proviso somewhere down below which says if you are an individual or HUF with turnover less than 1 crore, gross receipt less than 50 lakh, then you are not required to deduct tax at source. Something like this, which you will find in most popular sections, is missing in 192. This proviso, which exempts an individual or HUF without adequate business or turnover or professional receipts from TDS obligations, does not exist for 192. Sir made a point with regards to personal payment. 194C, 194J, 194C subsection 4 to be precise, makes a point that if the payment is for personal use, then TDS is not required. Even that is missing. Even that is missing under 192. So the end conclusion to be drawn is Mr. A in our case will have to deduct tax at source on the salaries that he is making for personal payment, despite the fact that he is a salaried employee, has no business. And what will be the consequence if he will not deduct? Agreed, 40A1A is something that cannot be invoked, but then TDS default has lot more consequences. 40A1A is just one of those consequences. There are other penal and prosecution provisions also available under the Act, which could get triggered in the hands of Mr. A if he fails to deduct tax at source. Right? Okay. Next one is possibly or hopefully of more practical relevance. Salary paid to Mr. A for the year is rupees 7 lakh. In addition, advance salary of rupees 3 lakh is paid on the request of the employee. What would be the taxable salary of the employee on which tax has to be deducted at source? 10. Obvious answer. Because section 15 tells us salary is taxable on due on receipt basis, whichever is earlier. 15A will go on to tell you salary which is fallen due is taxable. 15B will go on to tell you salary which is received, although not due, is also taxable. So obviously tax will have to be deducted at 10 lakhs and not 7 lakhs. Is there a way to avoid this? Loan. Needed money, therefore he took an advance. Now after that advance you're deducting his salaries and what's the way out for it? Loan. Categorize or rebrand that advance as loan. But will any other consequence follow? So under 17 subsection 2, read with rule 3, notional interest on that loan will have to be taxed as perquisite in the hands of the employer. So by categorizing it as loan, we escape on that 3 lakh additional salary being subject to TDS, but then we'll have to do this exercise of computing notional interest in accordance with the perquisite valuation rules and add that to the taxable side. But then just rebranding alone will save you from the TDS net? Will that? Would it really be in the nature of a loan? Because what courts have told us is loan is something which is normally repaid in monetary terms, whereas advance is adjusted against future supplies. Factually, what is going to happen in your case? Are you going to receive back the money from the employee, or are you going to adjust it against his future salaries? So, in substance, it is an advance which you are trying to categorize or characterize as a loan. What should I do in my audit?
What should do this? You pay salary,
Okay. So ask the SCM, ask the client first. You want to save on TDS? Take full salary and get back money from him as repayment of loan. Is that really required? Can't I argue before the department, hey, this would be unrealistic, impractical, and to an extent absurd? Can I argue, can I contest this to say, this is not an advance, this is a loan against salary? To require me to pay full salary to my employee and then take back that same money from the employee as repayment of loan would be impractical. No. Rather, I can always pass journal entries in my books to knock off the loan against the salaries that I am paying in future. Right? Possible argument, but as you said, the safest way to do it is the way sir has suggested, but then I think this argument should also hold good. In addition, as a matter of safeguard, what you can do is maybe have a loan agreement in place which spells out the terms of repayment and the terms of interest if there is any. And be very careful with the classification in your balance sheet. A lot of times we have seen genuine loans are also classified as advance to employees in the balance sheet, which creates a trouble at the time of TDS proceeding. To go against your own balance sheet becomes a little tough at the time of departmental proceeding. Okay? And also be very careful with the account head that you are using in your own books of accounts. Your own books you are calling it as advance, in the balance sheet you are calling it as, classifying it as employee advances, and now before TDS officer you want to fight it out that this is not advance but this is a loan. Makes life a little tough. You ultimately get away with it because the post of judgment which will say that entries or categorization in the books of accounts is not relevant, it is the substance of the transaction which matters towards at the end of it. But then just to make your life simpler, pay attention to two facts, have a loan agreement in place, be careful with the nomenclature that you are using in your books of accounts and in your financial statements. Is this visible at the back? This should be interesting, hopefully. Mr. Tax Evader, an employee, submitted false rental receipts and agreements to Employer Limited. These were considered for the purpose of tax deduction by Employer Limited Later, TDS officer or the AO examines the documents and identifies the documents to be fraudulent. What are the consequences in the hands of employer limited? In simple words, what is the extent of burden of documentation and verification in the hands of the employer? Is employer responsible for any false documentation by the employee? Or can the employer wash away his hands? I don't know. This came from the employee. Ask him. What do you think is the legal outcome of this dispute?
Residential address should be there.
Employee's residence PAN is there, everything is there. Sir.
No, residential address should be there.
Okay.
You can collaborate with this agreement.
Okay.
If it is there, you are safe.
But ultimately, it is found out that the documents are false, fraudulent. As a tax deductor, what are my obligations? To what extent am I responsible? The answer to this was given to us by Supreme Court in the case of L&T, way back in 2009. Categorically, Supreme Court said there is no legal obligation on the employer to collect and examine the documents with regards to deductions claimed by the employee. Whose employer? Is he or assessing officer? No, right? All that the Act requires the employer to do is estimate. That's the term used in the Act. The Act does not require the employer to compute. The Act only requires the employer to estimate the taxable salary of the employee, compute TDS, deduct and remit it to the government. In very clear words, Supreme Court ruled that employer cannot be made responsible for any of the shortfalls in terms of documentation with regards to various deductions that the employee claims in his tax computation. 2009, a lot of water has flown since then. 2015, subsection 2D got inserted into 192, which now mandates employers shall obtain from the SSC the evidence or proof of particulars of prescribed claims. So now there is a legal mandate on the employer to obtain proofs with regards to various claims made by the employer. Having gone through the Apex Court decision and 192 2D, now we will go back to the question and we will attempt to answer it. Now what is the fate of employer limited?
The only place to collect.
Gone case.
It doesn't say to verify the.
Perfect, bingo. See, what did Supreme Court say? Supreme Court said there is no obligation to collect and examine. Now what 192 2D has done is, it has only overruled this portion of what Supreme Court said. Now there is an obligation to collect. The Act only says obtain from the SSC. But the Act nowhere tells you to examine. Aggressive argument, but a possible argument. As an SSC, employer limited can always go back to the department and say, hey, see, 192 2D, what did you ask me to do? Obtain evidences. I have obtained. It is your job to verify. Not my obligation. And I also have the Supreme Court shelter which said obtain, collect and examine. Collect portion has been overridden by legislative amendment. Examine portion is still there to safeguard. Again, as I said, slightly aggressive in my argument, but we'll all appreciate a possible argument. Okay, we now move on to 194A. Borrower Limited borrowed a term loan from IDFC Limited. Interest paid for the year is 15 lakhs. Is Borrower Limited liable to deduct tax at source on interest paid to IDFC Limited? Simple yes, no answer. No?
Yes.
Yes. Yes.
Yes.
Why no? Financial institution, no TDS. Yes, why yes?
There is no bank of. We don't know that it's a financial institution. If it is a financial institution, or
It is a financial institution. IDFC Limited is an NBFC. It is a non-banking financial institution. Again, yes, no? Yes. Why yes?
There is no exemption for it.
194A exempts from TDS provision under 194A only where the payments are made to a bank which is covered under Banking Regulation Act. NBFC does not fall into this exemption, tax has to be deducted. This was the rather, I thought, easier part. A continuation of this, Borrower Limited paid upfront loan processing fee of rupees 30,000. Are there any TDS implications on this 30,000? What do we do in practice? Loan processing fee is there almost, loan is there in almost every SCM's balance sheet. Loan processing fee is also there. What do we do in our daily practice? No tax. Bank charges debit 1 bit. This cycle, why it takes more extension. Now to answer this, we have to look at the definition of interest under 2 clause 28A of Income Tax Act. Interest means interest payable in any manner in respect of monies borrowed or debt incurred, and includes any service fee or other charges in respect of monies borrowed or debt incurred. Right? So interest means interest payable for monies borrowed and debt incurred, and includes service fee or other charge in respect of monies borrowed or debt incurred. It certainly does not fall into the first bullet of interest, but it definitely falls into the inclusive definition of interest, wherein it says any service fee or charges in respect of monies borrowed is also interest. So this 30,000 loan processing fee that I am paying to an NBFC, to which there is no 194A exemption, I am required to deduct tax at source at the rate of 10% under 194. Something that we have to be careful about in our audits as well as daily application. Is TDS applicable on following payments? Liquidated damages paid by borrowers to finance company for default in payment of loans? Yes, you just study. Any charge that you pay in connection with the loan borrowed is interest for the purpose of Income Tax Act. You will have to deduct tax at source, and there is also this judgment of IDFC Company Limited. Discounting and factoring charges. Discounting and factoring charges. Check discounting, bill discounting, debtors factoring. Is any TDS to be made specifically under 194A? Half of minds are already, who's going to bat first? RCB. Man, toss yet to happen, sir. You can focus here. So what happens? Let's take an example of check discounting, right? Or for that matter, factoring also. I have a receivable which is maturing 30 days, 45 days from now, but I have an urgent need of money, right? So let's say 100 lakhs is something which is due to come to me on 45 days from now, but I need the money now. I'll take this and I'll get it discounted with any of the finances. In return, I'll get 95 or 92 or 90. So the differential is nothing but interest. It's time value of money. Money that had to come to me 45 days from now is coming to me today at a discounted price, and that discount is nothing but, in a commercial sense, interest. But this interest, which is understood by us in the commercial parlance, is not interest under the Income Tax Act. Income Tax Act we just studied, no? 228A. Interest means, it doesn't say interest includes. It's giving you an exhaustive definition. Interest means interest payable in respect of money borrowed or debt incurred. Now when I am selling a receivable, I am doing a check discounting or a factoring, I am selling a receivable. Am I borrowing any money? No. Am I incurring a debt? No. I am selling the asset at a discounted price. Therefore, on check discounting and factoring charges, no tax has to be deducted at source. And there is a host of judicial pronouncement support to this argument as well. Okay. Is TDS applicable on following payments? Continuation of the last slide. Chit dividend. Chit dividend paid by the chit fund company to the members of the chit fund. Tax to be deducted? No, because there again there is no borrowing in the hands of the chit fund company. Now what happens in a chit arrangement? The members of the chit fund come together, pool in some money, then there is a bidding. The highest bidder withdraws the money from the pool of course after some deduction of the bidding charges. That bidding charges is what is distributed amongst the members as chit dividend, right? Now, in this arrangement, in this setup, there is no money borrowed or debt incurred by the chit fund company. Therefore, this chit dividend which is distributed to the chit fund members is not interest in the hands of the chit fund company, right? And there is this Karnataka High Court in case of Avenue Super Chits and Sahib Chits, Delhi High Court, which will support this stand. So, we can fairly draw a conclusion. Chit dividend is not interest, no 194A. So this will be an incomplete conclusion, right? Chit dividend, no, not an interest, is true only in the hands of the chit fund company. Now look at this transaction from the point of view of the bidder who's withdrawn the money and who's actually paying that bidding charges. But to him, there is a direct borrowing, and in his hand, that's my personal view on this. In his hand, the dividend that he is paying or the bidding charges that he is paying is nothing but interest, even in terms of 228A. And therefore, he is liable for TDS if at all TDS provisions are applicable. So the conclusions have to be applied with caution. You cannot draw a blanket conclusion to say chit dividend is not equal to interest, is not equal to TDS. Chit dividend is not equal to interest is only in the context, at least the case laws, the precedents that we currently have is only in the context of the chit fund company paying the chit dividend. But if you have an SSC who's made the bid and who's borrowed money or who's withdrawn money from the chit fund, in his hands, would this judgment apply? Answer is no. Would TDS be applicable? My personal view, yes. Interest paid to vendors for delayed payments. This is going to be a significant decision to make in our upcoming audits.
In case of chit dividend, you told the bidder has to do it. I mean, there is a chance of deduction.
Possible, in my personal view.
But there is no direct payment from bidder to August.
Who's going to be the deductee is something that we have to figure out. But then there is some interest that he is bearing and he is also going to debit in his books.
Yes.
So that has to suffer TDS.
He will pay to the company.
So he will deduct it in the hands of the company.
But it is not income for company, no?
That's something that will have to be deliberated. No. Difficulty in the hands of the deductee cannot be a ground for the deductor to not deduct tax at source. But then my point, the point that I am trying to make here is, this Karnataka High Court and Delhi High Court judgment will not come to your rescue. You will have to fight your own battle.
Yes.
Right? Interest paid to vendors for delayed payments. This year that 43B has come, no MSME payments. You will have to identify, once you have identified the delays, you will also have to quantify the interest and pass provisional entries in the books of accounts. Those provisional entries, TDS is required or not? There are two tribunal judgments, Hyderabad and Ahmedabad, wherein the tribunals have told us interest paid to vendors is part and parcel of trading liability. There is no interest component in this payment because there is no borrowing. Are you borrowing any money from a vendor? No. So therefore, it is not interest, and because it is not interest, 194A does not apply. These two favorable rulings that we presently have. But again, in my humble view, this may not be a final position of law. Because in drawing this conclusion, both the tribunals have missed one key element in the definition of interest under 228A. They have only looked at one leg of the definition. Interest means interest payable with regards to money borrowed. It is not money borrowed, undoubtedly, undisputedly. But is it not debt incurred? Is my trading liability not, is it not a trade debt? Shouldn't be squarely covered within the definition of 228A? In my view, the answer should be yes. But then, as the position stands today, we have two tribunal judgments in favor. You may consider making use of it. In fact, there is one Madras High Court judgment, 1998, much earlier to these tribunal judgments, wherein the question before the High Court was not interest. The assessee had made some penal payments to his buyer. Had made some penal payments to its buyer for delay in making payments to the vendor. Now that Madras High Court said is a charge in respect of debt incurred, which is interest under the Act and liable for TDS. So if penal payment to the vendor can be interest, Interest to vendors is certainly interest. Okay. We are moving at a good pace. That's good. Can we wind up before 7:30? Let's put this outside the ground before the first ball is ball on the ground. Huh? Unlikely, let's see. TDS under 194C, you are required to deduct at the rate of 1% or 2% depending on who the deductee is. 194C has an interesting threshold limit. No? We have two thresholds. 194.5 tells us no TDS if the transaction value does not exceed 30,000. But then there is a proviso to 194C subsection 5 which goes on to tell us if the annual value of the transactions is exceeding 1 lakh, then you have to do TDS. There is a nice little interplay that we are trying to see between these two thresholds. Now we are presently looking at the annual threshold. A Limited makes following payments to B Limited for works contract during financial year 23-24. September 30,000, January 30,000, February 30,000. In all these first three payments, no tax is not withheld at source. The fourth payment made on 31st March, again 30,000. Should tax be withheld if yes or what value? Entire 1,20,000. That's the obvious answer. We'll have to deduct because the proviso will come into play. Proviso tells you do TDS on the entire amount. Unlike 194Q, where we are given a threshold of 50 lakh, but the provision clearly tells us on the value exceeding 50 lakh. That exceeding phraseology is missing under 194C, and we will have to do TDS on the entire 1,50,000 and not just 20,000. This is simple. Let's see if we can have a consensus, if we can have a single answer to this question. Two payments are made, 30,000 on 30th September, 35,000 on 31st March. I should do TDS on 35,000 or 65,000? 35 unanimous. Nobody supporting 65,000. 65. 65 2. 3. Okay. If you read 194C subsection 5, this is also there on the screen now, it tells you, it gives you a transaction level threshold. You have to check the limits for every transaction, and if it is less than 30,000, conclude that there is no TDS. TDS will come into a transaction for less than 30,000 only where the proviso kicks in, and the proviso kicks in only where the annual value crosses 1 lakh, which is not the case here. And therefore, I think it's a safe conclusion to draw that for the payment made on 31st March, tax is required to be deducted only on 35,000 and not on 65,000. Okay. Payments to clearing and forwarding agent, tax is required to be deducted. Yes. Which issue? See, anybody supporting J? 194C is something that even department acknowledges. Circular 715 clearly says payments to clearing and forwarding agent is liable for TDS under 194C. What about reimbursements made to clearing and forwarding agents? CA pages come with a big list of reimbursements. So what is the position with regards to reimbursements?
Separately for reimbursement and no TDS.
If he gives a separate debit note for reimbursement, no TDS. If he is including it in the invoice, if he is mixing it up, then we will not take the effort of segregating it. Pura TDS करके see peacefully.
Pura bill के.
Pura bill के. Now the correct answer. Courts have told us on reimbursement where there is no income element, there is no requirement of any tax deduction at source. But the key here is you should be in a position to prove that this is reimbursement and there is no income element. So you should always insist on the principal bills under which he has incurred those expenses and which he is now seeking to reimburse. Unless and until you have those as part of the documentation, you should not consider it as a reimbursement and do TDS on the entire. Okay. That reimbursement does not require TDS. There is a plethora of judgments. I am just leaving you with a bunch of judgments which are specific to 194C in the context of payment to reimbursements to CNF agents. But then we have to be a little cautious also here. Reimbursement of expenses should not be confused with reimbursement of liabilities. How are they two different? And that's what happened in the case of SEMA agencies. SEMA agency is an interesting case. Let me narrate you the facts. SEMA agency was a CNF agent who was facilitating exports for an exporter. As part of its facilitation arrangement, it made payments to an airline company towards carrier charges with whom the exporter had a direct contract. I'll just recap the facts. There is an exporter, there is a CNF agent, SEMA agencies, and there is an airline company. The airline company and the exporter have a direct contract for carriage of goods. As part of facilitation or CNF services that SEMA agencies was rendering to the exporter, SEMA agencies made a payment to the airline company towards carriage of goods. Now in this entire chain, SEMA agencies paid the airline company, exporter reimbursed SEMA agencies. So we have two transactions. Exporter to SEMA agencies, SEMA agencies to airline. Which of these two should suffer TDS in the 194C? SEMA agencies to airline, tax should be deducted at source. Okay, we have one view. SEMA agencies should have deducted tax at source, which is precisely what the department's contention was. Okay, any other view?
Contractual relationship was between the exporter and the
Perfect. See, the contract for carriage of goods, the works contract is between the exporter and the airline. There is no works contract between SEMA agencies and the airline. SEMA agencies has absolutely no obligation to deduct tax at source. When the exporter made payment to SEMA agencies, that was again reimbursement of liability. Again, there was no requirement of tax deduction at source. But when SEMA agencies paid the airline on behalf of the exporter, with whom the exporter and there was a direct contract between the exporter and the airline, it was the exporter's obligation to deduct tax and source. Right? I hope I am clear on this. I'll repeat this. Exporter making payment to CNF, no TDS. CNF making payment to airline company, no TDS. No TDS in its hand. But then this is the on behalf payment that the CNF agent is making on behalf of the exporter. So it is the exporter who is the person responsible for making payment to airline entity, and it is the exporter's obligation to do TDS on the payments made to airline company.
But either payment or credit is not going to that fellow, no?
No, you will have credit in the books, sir. And you will have on behalf payment. By way of journal entry, you are making payment.
We are not passing any entry for the airliner, we are passing for the CA.
In your books, you will have a debit entry for the expenditure that you have incurred, and you will have a journal to knock off the liability. You will have to.
That is the way, okay.
No, irrespective of what you do in your books of accounts, you are the person responsible for making payments to the airline company. You make a direct payment yourself, or you ask a friend or a third party to make a payment. It is your obligation to deduct tax at source.
Airline will put you invoice in the name of exporter.
Airline company will obviously make an invoice in the name of the exporter, not in the name of the
Because they both had agreement.
Because the agreement was between the exporter and the airline agent.
It is a contractual obligation.
It's a contract between the airline and the exporter, and therefore the TDS obligation rests on the exporter.
If CNF gets the invoice, then CNF has to.
No, but there is no contract between the CNF. CNF was only instructed make a payment and reimburse. So he made a payment and I'm reimbursing, but in this reimbursement I have to be careful that TDS in the hands of the airline entity has to be taken care of by me in my books.
The exporter may be only the balance payment to
That should be my instruction to the exporter. Hey, exporter, don't make 100, pay only 98 because I am going to deduct 2. That should be my instruction to the CNF agent.
But practically it is not happening.
It should happen, which is why I put this in red ink.
Because of rating we have to do it. So, sir, if example CNFA had agreement with the airline company.
If CNF agent had a direct contract with the airline company, and then it is seeking a reimbursement, then CNF agent would have deducted the tax.
Exporter? Exporter
CNF agent, exporter is only reimbursing.
Reimbursing. So exporter will not.
See, TDS in the 194C is applicable between the deductor and the deductee where there is a works contract. There should be a works contract for 194C to deduct. Yes. No works contract, no 194C. Simple as that. Payment to courier agency, TDS required. Why? It's a works contract. The works contract definition includes carriage of goods and passengers by any mode other than by railways. Right? And CPDT says carriage of documents and parcel is equivalent to carriage of goods. Do TDS in the 194C. Something that we've also been not disputing and we've accepted to it, and obviously in our daily practice also we do TDS in the 194C. This should be hopefully interesting and useful as well. Freight charges paid to vendor on purchase of goods. Should tax be deducted at source? Vendor has supplied material to you. He is giving you an invoice. Value of goods 10 lakh. Transportation charges 50,000. 10 lakh 50,000 is the invoice value. You will do TDS on this 50,000 under 194C. Yes or no? No. Freight charges?
For him it is.
It's not a works contract.
For the vendor it is.
It is not a reimbursement. I don't know how much he is charging, how much he is being charged by the transporter. Probably his transporter is charging him 40,000 and he is collecting 50,000 from him. I don't know.
It's not a works contract.
It is not a works contract. Okay.
It's just facility. Supplier is just merely charging for the facility of transport that he has given.
It is only a facility provided and there is no works contract. Perfect, sir. This is what even the courts have told us. In this scenario, the payments that you are making to the vendor are part and parcel of your purchase price. You don't have a separate works contract with your vendor for supply of goods, or rather for transportation of goods, and therefore, in the absence of 194, in the absence of works contract, 194C will not trigger, and you don't have to deduct tax at source on the freight charges paid to vendor. Something which even the board acknowledges in Circular 9 of 2012. But this Circular 9 of 2012 is in the context of gas contracts. In the case of gas contracts, assessing officers had been insisting on TDS under 194C, because in the gas contract where you will see a significant portion of the consideration is paid towards transportation charges of the gas. There are pipelines laid or there are other modes of transport arrangements made wherein a significant amount is paid towards only transportation services. And there CPDT has come to the rescue of the gas agencies to say, okay, this is not a works contract, this is a contract for sale. This is not a contract for any execution of any works contract, and therefore TDS under 194C is not required. Probably that also can be relied upon in making a conclusion that on this 50,000 that we discussed in our example, 194C is not required to be deducted. Extending this question further, assuming 194Q is applicable, you will do TDS at the rate of 0.1% on 10 lakh or 10 lakh 50,000? 10 lakh 50,000. Because here for 194C you have taken a stand that this is part and parcel of the purchase price. You cannot take a different stand for a different section. You have to stick on, you have to have consistency. And under 194Q you have to do TDS on the entire realization. Great. Some more issues. 194C में कितने issues? Restaurant payments. You take your team for a team outing, lunch, dinner, 35,000 is a restaurant bill. Tax to be deducted? No? Sure? Sure. That's what even CPDT tells us in a Circular 715 of 1995. No TDS. Great. What if you going, instead of you going to the hotel, the hotelier comes to your office premises and makes food arrangements for your staff? That's catering services. Obviously, catering is a specific inclusion in the definition of works contract. You will have to deduct tax at source, which is also what Bombay High Court tells us in Safety Hospital 2019 judgment. We'll quickly move on. Travel agent. Tax should be deducted. Yes. Travel agent, what services is giving you? He is helping you book travel tickets, air tickets. He is helping you book hotel, lodging and boarding. He is taking care of your food arrangements. He is taking care of your local travel and sightseeing. These are the host of services that he is bundling into one offer and one package and he's charging you a consolidated fee. On this consolidated package fee, tour package fee, travel package fee, should I deduct tax and source under 194C? Yes. So TDS में blindly you can say yes. Why take risk? It is not my money. If I am a deductor, I have to make 100 payment to the deductee, to the pay. I make 98 plus 2 or make 100. Outflow from my account is always going to be 100. So rather be safe, deduct 2 and be done with it. For a very long period of time, I always thought travel agent does not require TDS under 194C simply because there is no works contract here. It doesn't fit into the definition of a works contract. But then I came across a Bombay High Court judgment recently in the case of Reliance Insurance Company Limited, wherein Bombay High Court says you have to pay tax under 194C. Again, what logic?
The service element. Not on the full amount.
Not on the full amount. That will be difficult. 194C permits you to break down the invoice only when with regards to GST component or the material component. Beyond that bisection, I doubt if the law will permit you to do. If you have decided that tour package fee is works contract, the entire package is works contract. I doubt if we will be able to successfully argue to say that you can further dissect it to say.
Will have reimbursements as a.
If it is got reimbursements, then okay. But then normally travel operators don't give you a breakdown of the fee that they have paid to the airline company or the other travel agents.
Where he books a ticket alone.
If he's only booking a ticket for you, okay, and then he's seeking a reimbursement of the ticket and he's separately charging you a fee, then on the flight ticket charges, TDS is not required. That's a pure reimbursement. That I know. Okay. If you read this, even if you read this Bombay High Court judgment, there is no reasoning given over there. Why 194C is not explained. Actually, there the department had argued it should be 194J. SCC settled with Bombay High Court 194C. I say that because I don't see any reasoning given over there. But then you find this in green. If you've seen the pattern of my code coloring, cases where there is TDS, it is red. Where there is no TDS, favorable cases are green. Against cases, adverse cases are in red. This says deduct tax at source and yet it is in green. There is a reason for that. Pause on the TDS provisions for a while and for a moment jump on to 206C1G, which requires TCS on foreign tour packages at the rate of 5% if less than 7 lakh, more than 7 lakh, 20%. Now there are provisos to 206C1G. Come down, 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 down. Fourth proviso will tell you if the transaction is liable for TDS. If TDS is deductible and it is deducted, then 206C1G will not apply. So by adopting, accepting and applying this Reliance judgment of Bombay High Court, if I can successfully argue to say TDS under 194C is applicable and deduct 2% TDS under 194C, I can avoid 20% TCS under 206C1G, which is why it isn't green. This is possible, permissible, provided your travel agent agrees to this arrangement, because there he runs the risk of being an SCM in default with regards to 20% of the sum collected. It's a big risk for him. Again, because TDS and TCS principle is same, play safe. Correct, no?
But normally the provisions of TDS is always supersedes the sections up to TCS.
So the proviso very clearly says, you don't have to apply logic also there, very clearly says, if tax is deductible and if it is deducted, then no TCS. It is deducted is a fact which can be verified by TDS certificate and other entries in the books of accounts. Is it deductible is the question. Bombay High Court says it is deductible. Department is above Bombay High Court. Hotel boarding and lodging. No. Tax to be deducted? No.
If it is a specific room that is booked,
specific room
that is booked, then 194C, 194I,
194I
it is applicable.
Presently we deal with 194C.
Then it is not applicable.
194C not applicable.
Contracted owners?
Yes. Even then it is not.
If there is a contract, there is always a contract, no?
Even then it is not applicable.
Sometimes it is in writing, most times it is in oral. Not applicable. CBDT in Circular 681 1994 said applicable. Do TDS under 194C and had 1% or 2%, whatever the applicability. Didn't go down well with East India Company, East India Hotels. Promptly, 1994, they filed a writ petition against the circular before Bombay High Court. Promptly, in 15 years, 2009, Bombay High Court delivered a judgment on this. But this is a beautiful judgment which, given time, we should all make an attempt to read. There is a beautiful deliberation on what a work contract actually is. If you look at 194C, explanation to 194C will define what work contract is. But then the definition given to us is an inclusive definition. It does not give us the meaning of 194C. It only tells us works contract will include advertisement, broadcasting, catering, carriage, manufacturing and all of it. It does not give you the actual meaning of what a works contract is. That meaning, if you really want to understand the concept of works contract, this is a judgment that you should give a read. Now here Bombay High Court tells us works contract is that contract which when carried on culminates into a product or a result. There should be a production of some desired article, or there should be an accomplishment of a task. In hotel boarding and lodging, what happens? There is a room which is made available to the guest. He can go and occupy that room. There are some basic amenities and facilities, hot water, drinking water, blah blah blah, which is attached to that, electricity, air conditioning, which is attached to that room. Is there any work being carried on over there? Is there any contract for work? Bombay High Court categorically say no. And therefore, Circular 681 of 1994, to the extent it says that 194C has to be applied with regards to hotel boarding and lodging charges, is unconstitutional and was struck down by Bombay High Court. So the end conclusion is no 194C on hotel boarding and lodging. So this story began in 1994, although Bombay High Court put an end to it in 2009. Between 94 and 2009, a lot of galata happened. There were a lot of tribunal level judgments which said 194C is not applicable. And once that statement was made by tribunals, department started contesting, okay, 194C not applicable. This is nothing but room rent charges. Room TDS under 194I. That didn't go down well with Krishna Oberoi from the Oberoi Group. He in 1996 made an application to CBDT. Hey CBDT, you already taken a stand. Hotel boarding and lodging charges, tax has to be deducted under 194C. Please come up with a circular clarifying that because 194C is applicable, you can't have two TDS provisions applying to the same transaction. Please come up with a clarification saying that 194I is not applicable. And when CBDT refused to come up with such clarification, Mr. Oberoi filed a mandamus with Andhra Pradesh High Court, requesting the court to direct CBDT to come up with a clarification that there is no 194I on room rent charges. You to exercise this, constitutional powers, extraordinary constitutional powers, you need a valid reasoning to go before High Court with a petition for mandamus. Now the argument made by Mr. Oberoi was, because assessees have been deducting TDS under 194I, which is a higher rate of TDS, my working capital is getting impacted. And because my working capital is getting impacted, my business is getting impacted, which is in violation of my right to carry on business and profession under Article 19(1)(g) of Constitution of India. That is what Fort also said. I don't buy this primary argument of yours. If you are so concerned of your working capital, go file a Form 30 with AO, there is provision under the Act, get a load reduction certificate, safeguard your working capital. Okay. Court also went on to add, court could have dismissed on mere this ground. No, court also went on to add 194I is applicable. Decision came in June 2002. Immediately, Circular 5 of 2002 was issued on 30th July 2002, affirming the position, affirming the law laid down by Bombay High Court to say yes, 194I is applicable on room rent charges. But then, to be fair, it was a pretty balanced circular. They carved out certain exceptions to say certain scenarios, 194I will not be applicable. Let's look at those exceptions. So the individual representing the company that is a tax deductor, is making payment, example the consultant or the auditor, etc., which is later reimbursed by the company, no TDS is required. Your employee walks into ITC, books a room, and then seeks a reimbursement. It's difficult to do TDS over there, no? So those category of transactions, you said, okay, where a third party has made a payment and then you are reimbursing it, although you are bearing that expenditure, you are debiting it in your payment account, TDS is not required, we will exempt over there. Companies, tour operators, etc., entering into agreements for fixing of room tariffs. As Infosys Limited, I will have one umbrella contract with ITC Limited. Throughout the country, throughout the year, whenever my employee walks into your hotel, 3-star hotel, single bedroom, this is the fare that I am going to charge. If you have contracts only up till this fare agreement, again, CBDT says TDS not required. But if a contract also provides for an arrangement wherein the hotel makes available a room on regular basis with an earmarked room, that James Bond category, walks into any hotel, suite room, top floor is always booked for him. If that's the arrangement that you have in the hotel, then under 194I, tax has to be deducted. If you're not James Bond level, one level below him, okay, not top floor room, any floor room, always reserved for me, yet again you will have to do TDS. 194I is what CBDT tells us. So if there is a room made available throughout the given period, the contract period, whether or not earmarked for you, whether or not a specific room is earmarked for you, but a room is always made available to you, then it is room rent charges 194I will have to be taken into account in what CBDT deducts. Okay? 7:15. Toss it now. We'll quickly rush through a bunch of provisions now. 194C versus 194J. Recruitment services, tax should be deducted under 194J and not 194C. What CBDT tells us. If you are hiring employees and to hire employees you have engaged agency and you are making recruitment charges to that agency, tax will have to be deducted under 194J, not 194C. AMCs? 194C. CBDT says normally it should be 194C, but if any technical service is involved, then it has to be 194J. So based on this circular, there have been a bunch of judgments, there have been a bunch of cases wherein there have been a diverse set of conclusions with regards to certain maintenance of high-end medical equipments, which requires some technical expertise on the agency executing those AMC contracts. There are a bunch of judgments which say 194C, bunch of judgments which say 194J. This discussion I thought would be academic because today's date 194J fee for technical service 2%, 194C 2%. So it doesn't make any practical impact in our daily practice. So I thought let us not get into that academic discussion. Payment to electrician. I don't know why this came up for CBDT. Rightly or wrongly, CBDT says electrician is not a professional. 194J not applicable. Agreed to that one. It also went on to say he is not even a technician. It is not fee for professional services, okay. It is also not fee for technical services. 194J not applicable. 194C. Electrician community would have been offended, but then because 194C then provided for a lower end of TDS, I think they would have accepted it.
Sir, 194C applicable or not applicable? I did not get that.
194C applicable, not 194J. So this series of issues is a debate between 194C or 194J. CBDT says 194C, and because CBDT is giving you a beneficial circular, we will not dispute that. We will happily apply it in our daily practice. Okay. Is TDS applicable on bank charges, payment gateway charges? On your website, buyer pays 100, in your bank account only 93 gets credited or 97 gets credited. There's a 2%, 3%. Payment gateway charges will get deducted. No? 194H applicable or no? For 194H to apply to any transaction, two essential ingredients have to be there. Number one, there should be a commission. You can also call this as payment gateway commission, just nomenclature is not going to help you. Second and most importantly, there should be a principal and an agent. In the transaction between two principals, then there cannot be 194H. And in the case of payment gateway charges, courts are consistently held that there is no principal-agent relationship, it is a principal-to-principal relationship, and therefore there is no commission which is liable for TDS under 194H. The same they have held with regards to credit card charges. You may call it credit card commission also, but then again courts have said these are all fees for banking services. These are not commission in nature. 194H not applicable. Again, same thing with regards to bank guarantee commission. You call it commission, but it is in practice it is a fee for banking services. It is not principal to agent relationship. No 194H. We are now moving on to 194I. Tenant Private Limited pays Mr. Landlord annual rent of rupees 3 lakh and also pays on behalf of the landlord property tax of rupees 30,000. But tax to be deducted under section 194I by Tenant Private Limited would be 30,000 or 33,000. I am paying him 3 lakh rent. His property tax also I am paying on his behalf 30,000. I am debiting 3 lakh 30,000 to my penal account under whatever head. 3 lakh under rate, 30,000 into rates and taxes, or maybe entire 3 lakh 30,000 into rental expense charges. Tax has to be deducted on 3 lakh or 3 lakh 30,000. 3 lakh 30. CBDT is telling us do it on 3 lakh, not 3 lakh 50. The logic being, this 30,000 municipal tax that I have paid now directly from my pocket, landlord will not be able to claim it when he is doing his house property computation, because house property may only those municipal taxes which are paid by the landlord himself are deductible. If the municipal taxes are moved by the tenant, landlord does not get any deduction. So applying that logic, they have said enough if you do TDS on 3 lakh, on this 30,000 tax deduction at source is not required.
It is not an income also.
See, had the house property provisions worked differently, I could have argued that it is his legal obligation that I am discharging. It is his liability that I am paying. In that sense, it is his income. But then, think it will not argue. It's in our favor. We accept it and apply it. Security deposit paid to landlord, should there be a TDS? Security deposit is a security money. Only in exceptional circumstances it is adjusted against the rent. Otherwise, it is not in the nature of rent and therefore TDS is not required. But if your security deposit is in the nature of a rental advance, something which can be adjusted against your periodic rentals, then you have to do tax deduction, as was the case in case of Deepak. So Deepak, in case में what happened? Lump sum payment of let's say 10 lakh was paid as security deposit, and the terms provided, but out of that 10 lakh, 5 lakh can be adjusted against rent in the next 3 years. Another 5 lakh can be adjusted against 3 years after that. So such that by the end of the tenure, I have 0 as my security deposit. And there court said no, this is advanced rent, and because 194I requires you to deduct tax at source on payment or credit whichever is earlier, you will have to do TDS on this advanced rent as well. Lease premium for long-term lease. I paid 10 lakhs for this room, lump sum payment. Next 3 years this room is mine. I make no more periodic payments. At the end of 3rd year I get back my 10 lakh. Again, CBDT, there is a circular which says lump sum payments made upfront which do not get adjusted against any periodic liabilities are capital receipts, do not require any tax deduction issues. I am a bit concerned by the way they have worded it in the circular. They say because if you read the circular, you get a feeling that because it is a capital receipt, no TDS. If this conclusion was to be taken and applied in other cases, then we could have interesting scenarios where a lot of other payments which are capital in nature would get away from the TDS rate. Of course, but I think that is not what they meant. Mr. A and Mr. B jointly own a commercial property with a share of 50% each in the property. Tenant Limited is paying annual rent of rupees 4 lakh. Mr. A and Mr. B receive 2 lakh each towards the rentals. Tax to be deducted under section 194I would be, or rather, should there at all be any tax deduction at source under 194? No? So the threshold of 2,40,000 given to us under 194I, is it property specific or pay specific? Pay specific. Absolutely no doubts on that, no disputes on that. That is what is also put to us by the circular, and we also have this SBI's case reaffirming this. We move on to 194I. A and B jointly own a commercial property with a share of 50% each in the property. Buyer Limited is buying the property for rupees 90 lakhs. Mr. A and Mr. B shall receive 45 lakhs each towards their share. 194IA, should I do any tax deduction? Yes. Yes. There it is property specific. There is one Ahmedabad tribunal. In the case of Bika Bhai Purushottam Bhai Patel, this is not a very direct case, it's not a direct conclusion, but then you get an indication, because there the dispute is with regards to interest payment. There you get a import that tax has to be deducted because it is property specific and not pay specific. But then the subsequent decision of the Ahmedabad tribunal itself and also Jodhpur tribunal, tribunals have held that you have to apply the limits per person and not per property. Now this is a scenario where you have two sellers and one buyer. A scenario came up before Delhi tribunal where there were two buyers and one seller. There again, in the case of Vinod Soni, Delhi attach says no TDS. Although we have three greens here, I would apply it with a lot of caution, because to me, from a plain reading of the provision, I somehow failed to reconcile myself with the conclusions given by the writer. Let's see 194I first. 194I very clearly says no deduction where income is credited or paid during the financial year to the account of the payee as long as it does not exceed 2,40,000 rupees. Provision plain reading of it is very clear. It is payee specific and not property specific. If amount paid or credited to the payee does not exceed 2,40,000, no TDS. Now read 194IA. 194IA subsection 2 tells you no deduction under subsection 1 shall be made where the consideration for the transfer of immovable property and the stamp duty value of such property are both less than 50 lakh rupees. The section plain reading of it gives us an impression, I think a very clear impression, that the limit of 50 lakhs is per property and not per person. Here the limit is per payee. Here the limit is very clearly per property. So if in a single sale deed you have two buyers or two sellers, less than for 50 lakh or more than 50 lakh individually, as long as the sale deed consideration is more than 50 lakh, in my view, you should be deducting tax exemption. We are now jumping on to 194Q. Following are goods and therefore will attract TDS under 194Q. Shares and securities are goods. If you are selling for more than 50 lakh and you have a turnover exceeding 10 crore in the preceding year, you have to take care of 194Q 0.1%. However, there is a small relief available to you in Circular 13 of 2021, wherein board has said if the transaction is happening on a recognized stock exchange, you don't know who the buyer is. You know where you can do TDS. So there they said, okay, you don't have to do TDS under 194Q. What about buyback? If I am buying back shares for worth more than 50 lakh from a single shareholder, should I deduct tax in the 194Q? Yes? No? not required because they are 115 cubic XN. You have to pay that buyback tax of 20%, and once that is paid in the hands of the shareholder, it is exempt. It is fully exempt. And once you say it is fully exempt, there is no taxable income. TDS provision should normally not be applied. Electricity, so be very careful in our audits. In the case of NTPC versus State of AP, Supreme Court tells us that electricity is goods. So if your client has a BESCOM bill in excess of 50 lakh, please ensure you are doing TDS at the rate of 0.1% under 194Q. Otherwise, you will end up with a 30% disallowance under 40 year. Deducting tax from BESCOM का concept नहीं है. हाथ से भर दो 0.1%. Otherwise, 30% will be the cost that you have to otherwise bear. Right? Software, again, in the case of TCS, Supreme Court tells us, shrink wrap off-the-shelf softwares are goods. Please do TDS under 194Q. Personal goods are also goods. There is no relaxation, no relief as is available under 194G or 194C. So if you are an individual proprietor with turnover less than 10 crore, and let's say you are buying cement for more than 50 lakh for construction of a house, you are legally required to deduct tax at source at the rate of 0.1% under 194Q. You have to be very careful over there. Any doubts up to this point? Anything that you want to add or clarify or correct me on?
One question, that property thing, no? This practical question related to filling out 26 QB actually. Can I ask that question?
Oh, one second, I'm just having a question already here.
This 26 QB in the context of 194 IA,
yes.
Fill that up. I have a doubt there, but can I ask it in this context is what I
He will make a return,
so
a lot of CA schools.
So 26 QB when you fill up, it says that there are multiple sellers, multiple buyers. There's this box which says the property value. Stamp duty value, it says do it on a pro rata basis, but property value, it doesn't say any such instruction. So there, do we put the full property value or the proportionate?
What I do in practice. Let's take a numerical example. Two sellers A and B, 60 lakhs is the consideration, 1 crore 20 lakhs is the property value. You fill up two form 26 QBs as though that is the only transaction. Say property value 60 lakhs, amount paid 60 lakhs, stamp duty value 60 lakhs, be done with 126 QB. Then come to next transaction, as though it is an independent transaction, fill 60 lakhs, do 1% TDS, sleep peacefully. Because you fill up numbers over there, the way the traces works out with those numbers is sometimes funny. You never want to take any risk over there, unnecessary risk over there. And the easy way out is to report only 60 lakh each for both the transactions. At the end of the day, you are doing correct TDS and you are not reporting anything wrong over there. You should not be able to do that.
Single sale deed.
Single sale deed, but you have 226 QB, no? Your separation will also accept. You'll see acknowledgement number, oh, very they allow. Should not be able to do. And we have never faced any trouble. Okay? TDS or non-resident, we had to begin with agreed it is going to be out of syllabus. But then I thought there are some routine transactions which will have a macro level view. But before that, sorry, you had a doubt.
Regarding software, in case of the software is customized and we are capitalizing that software, TDS is applicable under 194C or
TDS is applicable under 194J. If it is a customized software, then under 194J you have to do TDS.
so it is capitalized or not?
Even if it is capitalized, you have to do TDS. 40A, as I said, is just one of the consequences of TDS default. There are other consequences which will catch you.
And regarding electricity, so like, isn't it a contractual relationship between the BASCOM and the business that they will be providing electricity service?
So, sale of electricity is sale of goods, is what Supreme Court tells us in the ATPC's case. It is purchase of goods. You have to handle 194Q over there. You have to apply 194Q.
Whether it is goods or services, but it is a contractual relationship.
That's okay. Every purchase contract is a contractual relationship. Every vendor, I have a oral or a written contract. The existence of contract will not safeguard you. 194Q will still bite you. And your earlier question was on software. Okay. You know that issue is being raised there. Software is also 194J, payment of royalty. However, there is a 2012 notification, I think 12 of 2012 if I remember correctly, or 20 of 2012, wherein board says if it is a subsequent transfer of software and the initial leg of the transfer has suffered TDS either in the 195 or 194J, and the seller from whom you are buying is only reselling, he is not doing any value addition, he is not tampering with the code or he is not making any amendments to the software, then TDS is not required. To explain with an example, let's say I am an importer, I buy licenses from Microsoft, USA. I do TDS on that software purchase at the 195 and I am selling it to you. On the face of my invoice, I make a declaration that this is a resale without any tampering or any value addition, and the initial leg of this transfer has suffered TDS under 195 or 194J, then you will not have to do TDS under 194J. Likewise, in the second leg or the third leg of the transaction, let's say you are selling it to a reseller, you are a distributor and now you are selling it to a reseller. So you will again make a declaration that this transaction, this software has already suffered transaction TDS under 195. This is a resale and TDS is not required. The reseller will also not do any TDS on the purchases that he is making from the distributor.
The importer will be making under
195 if I am importing. If I am domestically procuring, I do under 194G. Let's say I am buying Tally. I am buying Tally from Tally Private Limited and I am selling it to you. When I make payment to Tally, I will have to do TDS under 194J, and because I have done 194J and I am just a reseller, you will not do TDS on payments made to you.
Subjected that you give declaration.
I have to give a declaration on the face of the invoice. On the face of the invoice, or separate declaration will also do, but normally what we see is declaration is given on the face of the invoice. Regardless of this, whether I do TDS or not, I will have to report this in my TDS return. That's an obligation that I carry under the circular. Even if I am not doing TDS because of the beneficial notification that I have from CA, I will still have to do a reporting of this transaction in my Form 26Q.
At 0%.
Now there is a drop down available to you, wherein it helps you, allows you to select software purchase under that reference with that notification to say that tax is not being deducted, but that the fact that there is a transaction to this effect has to be removed. Commission paid outside India to a non-resident agent who does not have a permanent establishment in India, TDS is not required to be done because there is no income that accrues in India. There is a plethora of judgments. I just leave you with two jurisdictional High Court and tribunal judgments wherein courts have said no TDS is required. Ocean freight paid to non-resident. Ocean freight paid to non-resident. Again, TDS is not required. There is income which is accruing in India, but then non-resident shipping companies are subjected to accelerated assessment under 171. Before they leave the port of India, they have to make arrangements for payment of tax on income computed at the rate of 7.5% of their gross receipts here. So once the entire tax is collected in an accelerated manner, TDS provisions make no sense, and therefore board has rightly in its circular number 723 clarified that TDS is not required on payments made to a non-resident shipping company. Exhibition expenses, advertisement expenses carried out outside India, payment made to non-resident, no permanent establishment, no business connection in India, tax is not required to be deducted. Having said this, you have to be really careful where the advertisement expense is in the nature of online advertisement. If it is an online advertisement, then equalization levy will begin. So you have to be careful with that. Otherwise, trade fairs, trade exhibitions, stalls, all of that requires tax deduction. Again, there is a big list of judgment where you can be relying. This is next. Discuss applicability of TDS provisions in following cases. Mr. A BCom graduate, provides internal audit services to a private limited company. Mr. B, a chartered accountant, sells DSC, digital signature certificate, to a private limited company. For both these transactions, what is the position of TDS applicability? Straightforward. No. Payment made to Mr. A, you will have to deduct TDS under 194J. Payment made to Mr. B, no TDS. No TDS. Simple example. But the point that I am trying to drive home with the help of these examples is, 194J is service specific and not person specific. The test has to be applied with regards to the services rendered and not with regards to the person rendering those services. In the first example, in the first case, Mr. A is not a chartered accountant. He is not a profession in terms of the Income Tax Act, but the services that he is rendering are professional services. Auditing services is something which are normally associated with a chartered accountant, right? So the services being rendered are professional services and therefore tax has to be deducted at source. In the second case, Mr. B is a chartered accountant. He is a profession, notified profession. But then the services that he is rendering are not that of a chartered accountant, therefore TDS is not required. This is precisely what was explained to us by Bombay Tribunal in the case of Kodak India Limited. Kodak India Limited availed services of Katrina Kaif for a promotional photo shoot, made payment to her, did not deduct any tax at source. The department contested that Kodak ought to have made tax deduction under 194J. Reason? Katrina Kaif is a renowned actress and film artist is a notified profession under 194 for the purpose of 44A, and for the purpose of 194J, tax ought to have been deducted at source under 194J at the rate of 10%. Okay, there's a beautiful discussion on this, wherein Bombay Tribunal tells us, no doubt she is a film artist, but the services that she is rendering by way of this photo shoot for the promotional material are services of a modeling, are not in the nature of services rendered by a film artist, and therefore TDS is not required to be deducted. She is a film artist, no doubt. But what services did she render to Kodak? Did she render the services of a film artist? No, she rendered the services of a model, which is not a notified profession, and therefore TDS under 194J is not required.
For model, whatever we made a payment, then it is TDS is not
applicable. Modeling photo shoot is not equivalent of a movie shoot. It's not a film artist.
Not only actress, I was talking about a normal model.
No, 194J is not applicable, is what Bombay Tribunal tells us, but is 194C applicable? I would say yes. Bombay Tribunal has stopped at saying 194J is not applicable. 194C is applicable or not? That's a question open, and to my mind, 194C should be applicable. This is a works contract. This is resulting in the accomplishment of a task. TCS on scrap. The starting where you said only TDS, loss also over, first ball also bowled. What is the score, Vijay? Okay. Couple more slides and then we quickly wind up. TCS on scrap rate 1%. Now, out of the transactions that are listed here, tell me which of these attract 1% TCS and which of these do not attract 1% TCS. Fast, you will tell, fast, you will tell. Sale of newspaper, used computer, office scrap, scrap derived from dismantling of building, sale of old equipment in exchange of new equipment. Now, scrap is specifically defined in explanation B to section 206C1. So, scrap as we normally understood in the commercial parlance includes all of it, and in that sense TCS is applicable. But then the definition of scrap under 206C tells us scrap means that waste which is generated in the manufacturing process or in some other mechanical activity. Newspaper, old equipment is definitely not generated in the course of manufacturing activity. TCS is not required. TCS is not required. Right? Again, all these judgments are there to confirm our understanding. Timing of Form 27C. Okay, before timing of Form 27C, we have to understand what is Form 27C about. Now, 206C subsection 1 tells us do TCS on sale of host of items over there. There is scrap, there is mineral ores, there is tendu leaves, there is timber, there is alcohol and all of it. All those sales I am required to do TCS at the rate of 1%. 206C subsection 1A, however, goes on to give an exception to say, if the buyer is buying those goods for his manufacturing activity and he gives you a declaration to that effect in writing, then don't do TCS. Don't do TCS. And that declaration has to be given in Form 27C. Now the issue in hand is, when should I collect this Form 27C? Before the transaction, or is it enough even if I collect it after the transaction? So what happened in the case before Delhi Tribunal, the divisional forest officer failed to collect Form 27C. He sold timber to manufacturers. Undoubtedly it was used in the manufacturing process. But he failed to collect a declaration to that effect in writing. In the course of 2011 proceedings, when the TDS officer questioned him, at that time he woke up, he chased all his buyers, took a declaration from them on the Form 27C and submitted it before the assessing officer. Assessing officer said, nothing, I am not going to buy this today. This should have been in your possession at the time of transaction. Only if it was there in your possession at the time of transaction, you had a relaxation to say no TCS. You producing it now will not save you from 2011 proceeding. You will have to pay, you are a assessee in default. You will have to pay 2011 and 2011. And this argument of the assessing officer was also accepted by the Delhi Tribunal. Around the same time, this is 2015, a month or two later, Bangalore Tribunal also had an occasion to discuss on the same issue, wherein Bangalore Tribunal took a little lenient view. Read 206cc. Where does it tell you that the document should be procured before the transaction? Is it anywhere written in the Act? 206c 1b gives you a timeline for submission of Form 27C. It says you will submit the form within 7 days of the subsequent month in the month in which you collect it. So there is a time limit for submission, there is no time limit for collection. No, why are you taking such a hypothetical view? Case alone. While Form 27C might not be of relevance in our daily practice, but then a similar requirement exists under other provisions also. 194C, subsection 6, declaration from contractor, I own less than 10 goods carriages, no TDS. Form 15G, Form 15H, my income is below basic exemption limit, don't do TDS. Now, in cases, of course, I am not going to do a tax planning based on this Bangalore Tribunal judgment, but then in cases where there is a delay, can I take shelter under this Bangalore Tribunal judgment is something that I want to leave you with, to ponder about. Okay? In a case where you are stuck, possibly jurisdiction like that, see, 27C said, 206C, 1A said if there is 27C, no TCS, there is no time limit given for submission of Form 27C. There is no time limit given for submission of declaration of 194C6. There is no time limit given for submission of Form 15G, 15H. Even if I am able to procure these forms subsequently, I should not be facing consequences of a TDS default. Right? Again, as I said, not something to be planned and executed, but if you are stuck in a transaction, then this is there for your defense. TDS on GST component, no. Rajasthan High Court said no, then that Rajasthan High Court judgment was accepted and there was a circular 1 of 2014 where they said there will be no TDS on service tax component because that is what we had in 2014. Then 2017 when GST came in, there again they said no TDS on GST on service contracts. No TDS on GST on service contracts. Back those days we did not have 194Q. There was no TDS provision literally in 2017 which required TDS on sale of goods. Right? So on GST on service contract they said no TDS. But then consistently all across they have been insisting on two requirements. Requirement number one, the GST or the service tax component should be separately identified. It should be separately given. Number two, payment should be to a resident. If it is to a non-resident, I don't know why you would charge GST, but then that's the requirement given to you under the CBDT circular. Then subsequently when 194Q came in, again they clarified for the purpose of 194Q, no TDS on GST. In all these series of circulars, be careful. This GST wala exemption is there for TDS. It is not there for TCS. For TCS, you will do tax collection on the entire amount and not on the pre-tax amount. And that's what is also told to us specifically under Circular 17 of 2020, where they say TCS is on gross receipt. There is no scope of bifurcating that receipt into GST and non-GST component. On the entire gross receipt, you have to do TCS at the rate of 0.1%. Reversal of TDS. Can tax once deducted be reversed?
There is
Let's understand with the help of a couple of examples. I'll help you a couple of examples. May 2024, I have raised the invoice on my client 1 lakh rupees, 5 lakh rupees. At least, in theory, let me raise a higher invoice, no? 5 lakh rupees invoice is raised. Accountant accounts, GST input credit claim, tax deducted, 2 months over, 3 months over, no payment. Client comes, negotiate. Okay, 4 lakh rupees credit note I'll give you. Saving 1 lakh rupees. The question is, while accounting for this 4 lakh credit note, can the TDS also be reversed? The answer is no. The answer is no, because as a deductor, I am only an agent. Once tax has been deducted, the only act I can perform with regards to this deducted amount is to remit it to the government. It is only the principal, the government, which has the power to refund or reverse or adjust or do whatever it wants, whatever it wishes to do with regards to the tax deducted excess. Okay? And this is what is also told to us by Patna High Court. This was an interesting case of ITC. In the case of ITC, one of his employees retired, took a voluntary retirement, took some compensation, and there was a full and final settlement. At the time of full and final settlement, there was some error in TDS computation. There was some extra tax deducted at source by the employer, and it was duly remitted and credited to the employee's account as well. The employee was not happy with ITC. It went and filed a case before the labour court to say, see, I was entitled for X amount of settlement as my full and final settlement, but they have given me lesser amount. Labour court ordered ITC, hey, that extra TDS what you have deducted, no, pay it to the employee and close the case. ITC carried this case before Patna High Court, and Patna High Court then said no. Even if there is an error in the tax computation, once it is deducted and remitted, it is only and only government from whom the employee can claim a refund and not from the employee. This is one case scenario. Take a second case where service is entirely cancelled. I am in a negotiation with my client. I have accepted an engagement. I have raised a 5 lakh rupee invoice in advance. The invoice is accounted, GST is claimed, tax is deducted. 2 months, 3 months pass, no service is rendered, contract is cancelled, invoice is cancelled. Now the entries have to be reversed or cancelled in the books of the deductee, rather than deductor. In this scenario, can the tax be reversed? In this scenario, we have a Karnataka High Court judgment in the case of Wipro Healthcare IT Private Limited. Wherein Karnataka High Court has said, so in the case of Wipro it so happened, monthly royalty entries were passed. End of the year they realized royalty agreement is cancelled, so they reversed those royalty entries, they reversed the TDS entries also. Department objected to the reversal of TDS. High Court said, see, no service is rendered. There is no income accruing in the hands of the deductee. There is no requirement of TDS. And this Wipro High Court was also applied in the case of Avasthajano by Bangalore High. There is in fact even a board circular 13 of 2021 in the context of 194Q, wherein they don't allow you to reverse, but they permit you to adjust. In the context of 194Q, what the board says is, if there is a purchase on which you have deducted TDS, and subsequently there is a purchase return. At the time of return, you cannot reverse the TDS entry. But subsequent to the purchase return, if there is another round of purchase, then this extra TDS you can adjust against the second round of purchase. So they don't permit a reversal, but they permit a adjustment. Again, this is permitted under 194Q for TDS provision. It is prohibited for 206C. For TCS, board says it is always on receipt. On what you have received, once you have collected tax, it cannot be reversed, it cannot be adjusted, there is nothing that can be done about it. Okay? The reversal of TDS is not to be confused with refund of TDS. I deducted 100, but erroneously remitted 1000, like 0 extra again when making the challan. Now this extra 900 I can claim it back from the department. Share के मुँह से निवाला निकालने जैसा है, but possible. There is a form 26B that you have to file. Extra TDS remitted can be claimed back as refund form by filing for form 26B. We'll quickly do this case study and conclude. There's some more slides, but then I think I'm running out of time. There is one connected slide, immediately next slide. We'll do this case series and then we'll stop for the day. Mr. CA with gross receipts more than 50 lakh, doing good in practice, makes the following payments for financial year 23-24. Note, the land and house in question is a personal asset. So the question at the end of it is whether TDS is applicable or not. So let's try to answer it item by item. House rent 40,000 per month. House rent. Tax to be deducted or no? Tax has to be deducted. 194I does not give you a relaxation with regards to personal payments. You have to deduct tax at source. Cost of land purchase 45 lakhs. Less than 50 lakh, no. 194IA, no TDS. Brokerage for purchase of land 1 lakh. Tax has to be deducted. There is no relaxation under 194H with regards to personal payments. Architect fee for designing construction plan 2 lakh rupees. No. 194J gives you a relaxation to say if the payment is for exclusively personal purposes. If it is partially personal, partly business, you do TDS. But if it is entirely for personal use, no TDS under 194J, and the same applies for 194C also. If you are making payment to a builder for construction of building 20 lakhs, no TDS because it is entirely for personal use. Okay.
So in case of house rent, if I am paying, I don't have any income. I have something old property where I am getting income, or I had some money in my bank account. I am paying.
No, but then 194I will also tell you that if you are an individual and HUF with turnover less than 1 crore or gross receipt 50 lakhs, then not required.
So
CA is more than 50 lakhs.
Very good CA.
So 1 second.
Yes.
In the same case, what if the rent is 90,000?
You will still do the 194I.
5% or 10%?
No, you will still do 194I 10%. Mr. CA, employed in industry, that fellow was practicing in industry, makes the following payments for financial year 23-24. House rent 60,000 per month.
Yes.
Which section? IB. Here, I is not applicable, IB 5% is applicable. Cost of flat purchase 15 crores.
Yes.
These two slides summarize our profession, no? CA in practice buying plot for 50 lakh, 45 lakhs. CA in industry buying flat 15 crores. Cost of flat purchase 15 crores, obviously yes, 194IA and do TDS at the rate of 1%. Brokerage for purchase of flat 1 crore. 194H is applicable only to those individuals HF with turnover more than 1 crore or gross receipt more than 50 lakh. So 194H is not applicable, but then 194M is applicable to you, sir. You will do TDS under 194M at the rate of 5%. Same would apply to architect fee and fee paid to contractor. Here 194J and 194C is not applicable because I don't breach the turnover and gross receipt thresholds, but then 194M gives you a threshold of 50 lakhs. If you are making payment in excess of 50 lakhs, those payments which are otherwise covered under 194J, 194C or 194H will get taxed under 194M at the rate of 5%. I think there is nobody from organizing committee, so I am forced to continue. Year of TDS credit and the year in which income is offered to tax. There could be some mismatch with regards to the year in which you are offering income to tax in your right year and the year in which it is appearing in the form 26 years. There are three possible scenarios. Good case scenario, TDS is appearing in year 1, income is also offered to tax in year 1. What is to be done? If is good, simply file a return, offer income to tax, claim TDS and TDS schedule, it will be processed perfectly fine by CPC. No issues. Situation number 2, TDS is appearing in year 1, but income is offered to tax in year 2. Possible, no, a lot of time it happens. Tax is deducted on payment of credit whichever is earlier. I am following cash system of accounting. But tax has happened in the preceding year, but income is being offered to tax in the current year. What do I do?
Carry forward.
In year 1's ITR, I will have to carry forward that TDS. In year 2's ITR, I will bring forward that TDS and I will claim it in year 2's ITR. I will do it correctly, but CPC will do it correctly. It's something I don't know. Third case is rare but possible scenario. TDS is appearing in year 2. Income is offered to tax in year 1. Unbilled revenue, I offered it off. Auditor, stat auditor said no, offer it to tax. But the recipient of my service, the bill was issued in year 2, he deducted tax in year 2. What to do? There is a carry forward mechanism in the idea. There is no carry back mechanism in the idea, no. Until last year, the only remedy you had is file an appeal. But now, Finance Act 23 has amended 1.155, inserted a new section, subsection 20, to say, file an application under Form 71. File an application under Form 71 in year 2. Department will give you theoretically. What is the time limit to file this Form 71? Time limit is 2 years from the end of the year in which it is appearing in a Form 26 years. So from the end of year 2, you have 2 more years to file your Form 71 and claim the TDS. There's actually a fourth positive scenario also positive. Not appearing in 26 years at all. What do you do? Unfortunately, this is something I've been repeatedly telling on a lot of my other sessions also. This is one area where we've given up. Who will fight CPC? Obviously, CPC is not going to give you any credit because it is not appearing in Form 26 years. But then, 205 of the Act very clearly tells you if TDS is not appearing on Form 26 years, but where it has been deducted at source, it is the default of the deductor, not the deductee. For the default of the deductor, you cannot penalize the deductee, you cannot recover that amount from the deductee. If at all any recovery has to be made, it has to be made from the 201 may elaborate procedures are there. No, the government has to exercise its powers under 201 and recover it from the deductor. In fact, there are CBDT instructions also clearly to this effect that you will not collect the demand, you will not adjust refund, but then in practice we all know how fairly and truly this is followed in real life practice. But then, as I said, the law is in your favor, it is just that you have to fight it out to avail this benefit, avail your right. Okay. I think I'll stop here, there are a couple more slides, but then we have run out of time and we'll conclude, sir. If you give me 5 minutes, I think I should be able to please cover it. Consequences of TDS default. So 40A1, 40A1A, as I said, is just one of the consequences. 40A1 you suffer 100% disturbance, 40A1A you suffer 30% disturbance. You are deemed to be an assessee in default 2011. The entire tax which ought to have been deducted will be recovered from you by deeming you to be an assessee in default. 2011A, you are liable to pay interest at the rate of 1.5% for delay in payment, at the rate of 1% for delay in deduction. Penalties under 221 to 76C for failure to deduct or failure to remit after having deducted, and of course late filing fee under 234E. This could become severe in a lot of these challan cum return payments, This 26QB, 26QC, 26QD, you will not just suffer interest under 201A. Because it is challan cum return, you will also suffer late filing fee at the rate of 200 rupees per day. So you have to be careful. Actually, very careful.
That is limited to the
amount of tax deducted also. Disturbance in case of short deduction. If there is a short deduction, will I suffer 40A1A disturbance or no? I have made a professional fee of 1 lakh rupees. I ought to have deducted under 194J 10% 10,000. But for some reason my accountant has deducted under 194C 2% 2,000. Will this 1 lakh suffer 40A1A disturbance or no? Calcutta High Court, Delhi High Court says no. It's there in the screen. Calcutta High Court, Delhi High Court says no disturbance because 40A1A provides for 30% disturbance on any sum payable on which the tax has not been deducted in accordance with provisions of Chapter 17B or after having deducted is not remitted. So basically 40A1A covers only a case of non-deduction or non-remittance. It does not apply to cases of short deduction is what Delhi High Court and Calcutta High Court tell us. But then there is a Kerala High Court wherein Kerala High Court has dug deeper into the wordings of 41A to say such tax which is deductible under chapter 17B. The word such tax refers to a tax which is deductible under appropriate provisions of the chapter 17B. If tax is deductible under 194G and it is deducted under 194C, it is not proper deduction. It is not such tax which is being deducted under 17B. And in any case, 41A does not postulate a complete failure of tax deduction. Even partial failure of tax deduction will attract 41A, is what Kerala High Court tells us. Is TDS applicable on provision for expenses? To cut the very long story short, if your play is identified, if the quantum is reasonably ascertained, then you will have to do TDS even on provision for expenses. So with this, I think I conclude my slide, and I hope we've answered this question with which we begin our session today. Why this session today? Why this tomorrow? Right? I hope it has added some value to the professional style over here today. Thank you for a very patient hearing. Thank you very much.
Thank you so much, CA Deepak Chopra. That was really an insightful session. I am sure the full crowd sitting here till the end of the session is an proof for that. So thank you so much. I request our chairman, CA to give a token of appreciation to today's speaker, CA Deepak Chopra. Can we have a round of applause? Thank you, members, for attending today's session. Have a good week ahead. Thank you so much.